We're always starting with this disclaimer because risk is the most important part of trading. It is your defensive posture. It is the one thing that's in your control. After you put on a trade, you have no control. The only control you have is the choice you made on how much lot size to use in relationship to your stop out. And that is the secret knowledge of trading. So I hope you enjoy our DMR tonight here for, let's see, what is the date? It is the 19th of November 2019. I want to welcome everybody. It's always a pleasure to see you. I want to start out with a quote here that's going to help everyone as traders who are dealing with this idea of having to lose a third of all your trades even when you're trading really, really well. Maybe you lose 1/5 of your trades when you're trading really, really well. Doesn't matter. You're going to lose as a trader. It's a strange business. In most businesses, we can get close to perfection and, in fact, have pretty good results. In trading, however, you will fail a portion of the time, no matter what. So let's twist this word failure a little bit with the help of Napoleon Hill. Failure is not a disgrace if you have sincerely done your best. And what does that mean as a trader? There's a gigantic book that can be written just on that, but we can talk about what is your best as a trader. Well, I've prepared to trade the markets by developing a statistical edge that I can look back a year and a half, maybe 2 years, and I can see that edge playing out. And I've done the actual work to be able to get in the market in those times when that edge appears. And then I might have clicked the mouse at the exact perfect moment in the exact perfect trade, and it went against me and the trade stopped out. That is not a failure, right? It's part of your system. So this is the bridge that everybody has to cross at one point or another in trading. And I maintain that a certain portion of us are drawn to trading to deal with certain elements that are still lurking around in the subconscious mind that have not resolved yet. Because every time you take a stop loss, it has a tendency to, by the law of association, trigger past traumas of an economic nature. So if your main wish is to get over your past, sometimes nothing like jumping in the deep end of the pool can help that. Interesting, we have a pool shot here, and we're on the deep end of it actually. I can see the dark water in this area. But you see what I mean? So there's a way sometimes to trigger past events by really thoroughly having those trigger moments and allowing them to be fully triggered. Right? Then you can look in your past and you can see what is it, what's going on there, and you can clean it out. I'll guarantee you, even if you're the best trader, you're still going to have 1 out of 5 of your trade setups turn into a losing economic loss for you. So it matters how you set yourself up to take that loss, obviously. But at the same time, there's this unique little calculus that happens only in trading. I haven't really found it. I guess the only other area that would happen in is probably Mortal Kombat, which you don't really walk away from if you're on the wrong side of it. But between military engagement and trading, those are the only 2 areas where you're really faced with these intense triggers of past economic events, or in the case of military, there's other stuff that would be triggered, but these are things that are very intense. And so trading is a very intense business. Okay? So we live in a competitive world that measures success by winners and losers, and insists that every victory creates a loss of equal dimension. If one person wins, it seems logical that someone else must lose. Well, we understand that in the Forex market, it is a limited pool, but it's an absolute monstrous one. What are the latest numbers? Let's refresh ourselves on this. And I do sometimes enjoy going back into the Bank of International Settlements figures just to get a sense of this, because this is not imaginary. It's the daily liquidity amounts. And we'll make sure we open up the updated one. So we're talking 5.8 trillion a day in the US dollar. And the GU, we're looking at 843 billion a day traded. Now we have to chop this number into thirds to understand the spot market, because a majority actually of foreign trading is future forwards and other types of instruments. We're looking at the spot market. It's about a third of this number. So that's a significant amount of money traded. That's certainly probably a lot higher than most of us would imagine it to be. So we really don't have to worry about this idea here that when we win, someone else loses type of thing. Yes, that's true, but the pool is so big and there are so many liquidity providers in here that we can say of the currency that's floating around in any one of these individual markets, we can say that only a small portion of that is retail currency. The majority of it would be interbank currency. It would be liquidity provided on leverage by the institutional banks. So we're really not in this place where if I make a trade and I win, Joe on the other side loses, right? Or I make a trade and I lose and Jesse on the other side wins. It doesn't work like that, right? It's a bigger pool. So we're straightening out this idea of failure in terms of a trader. In reality, the only competition that matters is the one in which you compete with yourself. When your standard of performance is based upon being the best you can be for yourself, you will never lose. So did you enter at the right place? Did you do the work necessary to generate a statistical edge that you can simply prove by simple math? If so, you took a stop out, but that is meaningless in the big picture. It's not a loss in reality. It's certainly not a failure. If you stick by your own trade rules and you persevere through that 1/3 of the time, it could be up to 3 out of 5 trades you win, 2 out of 5 you lose. If you can persevere in your own rules, you will still improve. You will only improve. You will only improve if you stick by your rule set and take the hits as they come. Make it a practice to objectively review your performance from time to time. When you fall short, assess the situation. Ask yourself, is there anything I would do or could have done to change the outcome? If you're trading your rules that you've put through an algorithmic historical study, there really is nothing you would change. So the answer would be no. And if you're satisfied that you've done your best, don't waste even a second of time reliving the past. Reliving the past. This is the big deal when it comes to all things human. We tend to have traumatic moments and they trigger the past. And the way our subconscious mind is wired is that it doesn't differentiate time. It thinks that past is now. So to some degree, if you've been ripped off or you've lost money through deception or maybe by your own deceptions or whatnot, when you have a triggering event and that unresolved issue in the past comes up, it's as if it's happening right now. It's as if it's happening right now. And that's only a portion of your personality is going through this. And it happens to be the portion with the greatest degree of control. That would be the subconscious. It is far, far more serial oriented. We're a linear conscious mind, but our subconscious is a serial processor. So it's going to affect in one way or another that past event that you're basically living now is going to do something. You're going to do something. If it's knocking over a glass of water onto your keyboard, if it's wanting to have a distraction so you're pulled away from the charts, whatever it is, there's a part of you that's trying to peel away from having to face that thing. So didn't intend for this to get into a psychology session, but why not? It's definitely going to be a part of your experience if you're thinking about trading money, especially big money. Okay, so don't waste time reliving the past if all you've done is followed your rules, right? Simply learn what you can from the experience and then go into action again. I'm wondering, these guys, the way they post these articles here at Napoleon Hill, I do suggest go ahead and sign up, let them hit your inbox. But boy, it's almost as if they've got a hardwire into my brain in terms of things I'm thinking about or considerations I'm having for all you students. It's definitely interesting how they sync up. But anyhow, higher knowledge always works that way, right? You find what you need to find at the time that's necessary, right? So simply learn what you can from the experience and then get into action. Take the next trade. When the next setup happens, you're in it, right? If you consistently do your best, your temporary failures will take care of themselves. And that brings up, again, the most interesting illusion I've ever heard of a trading story. And that was a guy on a trading desk who was actually excited to have his stop hit because he hadn't been out for a while. And now he could take a break and go on his sailboat and have an afternoon because he hit his daily walkaway risk limit. And he knew it was in his system. He knew it didn't blow him up. But he was almost looking forward to that stop loss coming because, gosh, he was tied up on the desk for too long. He'd been there for days. Feeling that pang of a confined space. He just felt like being out on the water on a sailboat. And he got a stop loss. And, hey, it was a good thing for him. He was in his rules. He knew his reward-risk ratio. He knew his hit rate in terms of his signature trade. He was obviously within risk ratios because the risk portion of the desk didn't cut his trades. Right? He was able to just take it and make it a good thing. And that's how he looked at it. It's a good thing. I was able to walk away. And he mentioned it to some of the other newer traders on the desk, and they were like, oh my God, did you hear what he said? He was happy he got stopped out. And they all kind of huddled together and they're like, what did he mean? How could that possibly be? But that is actually the case if you're within system. Stay within system when you're trading. Forget about the monkey business. Okay, we are looking at a chart here. I want you to give me a level count on this. Pop quiz time, folks. Pop quiz. Hey, thanks for that link, Brad. I will send it forward. And drop that link there. Okay, so you go, if you don't want to participate in this pop quiz, you can definitely grab that link and ask Napoleon Hill to send you wisdom to your inbox every day. You won't regret it. Okay, see what we got. All right, one person has said what they see here. Okay, 2 people. Hi, Patty. How are you, honey? Okay, 3, 4, Jeffrey, Vladimir, Brad. Okay. Okay, Vladimir, are you relatively new? Have you been with us? How long have you been with us, Vladimir? I think you're new. I think you're a new person. Are you a brand new person? Hi, Robert. Good to see you. So, Vladimir, let us know how long you've been with us. This is your first day. Wow. God bless you for participating in a pop quiz on your first day. Wow. I wish I knew how to say welcome in your native language, but that's all right. I'll learn it at some point. Okay, so we talked about this in the pre-market last night. And I always feel limited when I see a chart like this, when I see chop for 1, 2, 3 weeks, and then I see this upward movement, right? I'm able to pick 3 out of this upward movement, right? See the 3, see the 1 up, pull back, 2 up, slight pullback, and then the 3 up. I'm able to pick out that 3 and then the deep close. So I know that adheres to 3rd hour of the 3rd day of the main class that we did with Steve. For anybody who wants to take the general class again, you will answer this question perhaps differently if you go back and review that. But anyway, I'm always limited when I don't see a D1 chart. So let's pull up the D1 chart and I'll ask you what you see in here that might assist in your level assessment. Okay, nice, Michael. I agree. Okay, Nikita, I'm not, good to see you, but I'm not in agreement there. Okay. Yeah, there are 3 pushes. Okay, so again, anybody that was in the pre-market last night, you already know the answer to this, and we got it right. We got it right, but let's take our time through this because this is how I want you to train yourself in the markets. Nice and slow, systematically look at charts on the edge before they make the move, and begin to develop the dialogue that we teach you, which is a market maker approach. Right? So we see a trap line across the most recent highs back here in October. And you can see how we slightly breached through that. See how we slightly came through that? That's a tell, right? A tell is a name given to a movement that a poker player makes that reveals his intentions, right? So this is a tell by the dealer when they do that. They poke through a previous high and pull it all the way back down, okay? So now let's take ourselves back here and we're going to affix this trap line across from the D1 chart. And you're going to see how the trap line sits just beneath that 50 midline, mid figure, right? So it's beneath the $50 point. This is a $00 point. This is a 50. This is a 000. This is a 50. And then you have 25 and 75s in between. So these are each 25 pips in distance. Just so you know, when you're looking at an H1 chart, this is all taken from the WSM viewer as well, just so you know. If you're interested in using our study tool, it is populated with these 25 pip lines on all the time frames above the M5. When you get down to the M5 and the M1, it's 10 pips apart. But you can see 25 pips of distance, so I can see from the top of this candle. Well, anyway, I'll just roll forward here. Okay, so here's my 1, here's my 2, and then here's a vector. Notice the speed, how this is a larger speed, right? It was fast down here, but it wasn't quite as deep. It was fast here, but it wasn't quite as deep. This is a much greater distance with the speed up here on this 3rd area. I hope you see that clearly. All right, then we can make that as a 3 on top. So there's our 3 that is inducing traders past this trap area. Now let's just jump back to that D1 chart and we'll have a moment of silence for those people that take breakout trades on D1 charts by putting pending orders just on the other side of these previous highs. And yes, indeed, there are plenty of those traders who will take the breakout of that move. And the dealers know that. And more times than not, they're going to pull back against those guys and run their stops. Right, the only people that can weather a strategy like that is with a 200 or 300 pip stop. So you'd have to be pretty well funded to be able to make any headway with 200 pip stop. Okay, so the next thing we want to do whenever we see a possible single spike peak. Now, how do we know this is a peak? Well, we don't really know yet. What tells us is the distance of this pullback. And you can see the pullback. So just looking at this, I hope you can look inside of this chart and estimate how far the distance is. So again, this is a 50 and it's the suffix. It's on the last part of the number of the currency. So that would be 14050. When this, yeah, it would be 14150 up here. So this would have been 14150. The next one down, of course, is 14125. And there's your 141 even. And there's your 14075. So it's the last 20, it's in 25 pip increments there. So you can see the distance. We're generally around 75 pips in distance. Now in that third day, third hour of the general class, we covered this idea of away from peak trading. And these rules need to be basically stenciled to your forehead or in a neon sign black light type thing. You have to really get this part, I believe, first and foremost. Because again, when you're dealing with trading, oftentimes people get so interested in the lower time frames. It becomes an allure to just, wow, look at all the tricks I've learned on the lower time frame. I can take this time frame, I can take that time frame. Isn't it wonderful? Look at this trick I learned. I can trail a fib, I can take a break of a trap area, I can take a zone flip, all that kind of stuff. But if you don't have the higher time frames, you're basically going to get smoked by the big guy. Right? So higher time frames, H1 chart, H4 chart, D1 chart, that's the big guy. That's you if you're only a low time frame trader on the M15, M5, or M1. If all you're doing is looking at a 15-minute chart with nothing else, please make sure you're only doing that in demo because you are going to get smoked long term. Okay, so we'll keep this big guy around. I want to make sure that that concept is thoroughly drilled into. So what we're talking about here, many days of rise or drop. We've got a few days here of rise. We've got MW head and shoulder U-shaped or a single spike peak. We've got a single spike peak. We've got a close of the day at the extremes, relatively speaking. You don't find too many extremes on an A or V pattern, but we've got a close of the day. There's not much of a pullback after the low of the day. The low of the day is right here, so it's pretty close to the low of the day. So we'll call that the extremes. At least 50 pips from peak to close. That is AFP. And we should all know which direction that away from peak is presenting here, right? Don't need to type that in. Don't embarrass yourself. Don't type that in. It's an AFP short, okay? So again, I've done a lot of lessons on this, some of which have a visual accompaniment that I want you to avail yourself of because it's a very important thing for you to see why these work. It's one thing to say, yeah, it seems like they work, or yeah, Jim tells us they work, but what is it to know that these things actually work? It's really to see how the game is rigged, what the market participants are doing, how they are responding after they've been stopped out the first time, which would be on this thing, which is called a primary shift, and then wait for the rest of this thing to play out, which is going to trigger all the things that we talk about, that I've talked about a lot in previous DMR sessions. So I'll take you into my thread here just so you know where this is. Right? So Jim DMR sessions, come into this. Obviously watch this first one. It's the most important one. Got a bunch of new links here for you. But if you want to come down here, I'm thinking the AFP stuff, we'll just fish around here until we find it. I want to drop a link for it. Okay, it's earlier than that. It's not that late. I think it's the second, maybe it's the third link. Let's see if we get lucky on this one. Third link, third link, third link. Not quite, not quite. These are all pretty important. Let's go to the second link of 2019. I did a recent one that I want you to focus on that's actually really cool. Down here, was this it? Nope, 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 nope. I should have these all labeled properly. I do apologize for not having it all right there ready for you, but we've got, oh, there's the salt paper. I was looking for this one last week. That's how the psychology in our world, unfortunately, they figured stuff out 100 years ago and decided to keep a bunch of it from us, and so they're using it against us in trading. Okay, here's the volume studies. It's going to show up anytime. Nope, I don't know where it is. So won't it be interesting if I lose this one, but find all the others? So that's interesting. That's AFP, but that's not the one I was looking for. So I'll have to dig in a little deeper into this and find it. Let's do link 4. I don't think I did that. Yeah, we did that one. So it's in one of these. It's a DMR based on, and I know I've got the initial screen up for it. So let me just go back. So definitely go through all of these as best you can. And I think we did 3 Yep, we did 3. Let's go to 2. I want to find this one. I bet it's in here. I just missed it. No, no, no. It's probably more recent, and I don't have it up in this queue as of yet. Let's try one more time. If it's not here, we'll move on. Yeah, it's not. Unfortunately, it's not here, but I did a big set. There it is, at the bottom. I didn't go down far enough. Okay, so in April of this year, 2019, I did this session where I talked about imbalance of volume. So in your mind, you need to get this idea pretty stenciled in there. So right now, we're at this part, right? We've had the one move up. Buy volume, sell volume is equal. Second move up, a little more buy volume than sell volume. This third move up, this vector move, puts a lot more buy volume in the market than there is sell volume in the market. And what this tends to do is it draws in all these buy orders that have stop losses connected to their positions, unless, of course, it's Steve's mentor, who was gifted enough not to use stops, and that's true. You can ask Steve yourself. His mentor did not use stops because he was so used to being on the other side hunting stops, he didn't want to reveal where he was. I don't recommend that. Steve doesn't recommend that. You need to have a stop, preferably with your broker. If you have an EA that does this auto stealth stop garbage, that's all nice and fine until your fee drops, and that gives the broker, if they see you taking stops on an EA, they could so easily basically shut your feed and say it was on your side, and then you get gapped out. So you need to have a hard stop with the broker. If you want to put a stop further out with the broker and then take the other stop manually, yes, you can do that, but don't ever get in a large position that you do not have a stop with the broker at. You always have to have a stop with the broker. So anyway, all these stops on these long positions show up down here, and there's not that many stops above. Right? Not that many stops above. So what do you think they're going to do? Well, what they tend to do is the obvious, and that's why this shark is looking at this bigger pool of fish than the smaller pool of fish, right? Go back and check out this lesson if you haven't seen it. It's one of the better drawings of that I've done. I think it's pretty much the best of this idea here, the kill shot that goes on. So we have this pullback, which has killed all the people that were long up here and ran all their stops. And what human emotion does is it wants to get a revenge trade in the exact same instrument that it lost on. It's going to make it back in euro. So that's basically where we are here. So that's an AFP. So we're expecting a move higher to reinduce those that got stopped out on this pullback. Then we're looking for some type of trapping activity. It could be for a while. It could be stretched across several candles. We're looking for trapping activity. And then we're looking for the kill shot, which is where a lot of these people that got stop hunted on this first pullback are going to get hit again, but they're using higher leverage because they're trying to get back what they lost on this first trade. Okay? Yeah, Patty, thanks, hon. I know you like that one. I do too. It's the everything else. It's like the story behind the story, what we were never told. Right? It's pretty cool, actually. As everybody's doing this, you're not doing that because you have the ideas correct, right? So that's not you. All right, so very good. Let's see here. My dad doesn't use stops either. Interesting, Vladimir. He's been losing for 20 years. Oh my God, that's so funny. That is hilarious. My dad doesn't use stops. He's been losing for 20 years. Vlad, welcome to our group, my brother. All right, so here you go. It's a dealer's playbook. You need to remember this as if it were the multiplication tables. Or even better, addition. 1 + 1 = 2. Right? It's the most important aspect of what we're trying to get you to understand in this group. Okay? Don't be that guy. Remember, you let him go. Just let him go. All right. Looking at this chart, we have a nice AFP condition. We're on the H1 chart, right? This was our pre-market check down. So this is our H1 chart from last night that we dropped about 9:30 p.m. Eastern Standard Time. This was posted, this chart exactly like this, drawn like this, with the trap lines like this. Remember, join me in the pre-market sessions at 8:30 on Monday night and Tuesday night, and you'll get a little additional stuff out of it. I do stand guilty of sometimes going into things I don't go into in these more organized pre-market, these more organized DMR sessions, because it's a little more on the edge of the chart. So a lot of times I break away and talk about stuff. I know it can drive some people crazy that those pre-markets go 45 minutes, sometimes an hour, but I make sure to post all the materials for you so you're able to actually get to it. And so you come down to daily market review, go up to pre-market videos, and then come in here for the pre-market scans. And so last night would have been this one right here, right? So this was our check down here, and this was GJ. Okay, so we were AFP short, only one direction. we had a D1 trend along, but pretty much ignoring that. We've got a D1 trap area on the top edge where they trap some volume, as we just noticed. Our 5200 is pointed long. We would expect that in a tight single spike peak situation. But notice GJ, AFP short. So you come down here, you can load these. I post, obviously, the daily trade organizer. I post templates. So if you wanted to have this template, you could have had that on your chart, actually, drawn out for you. I don't have that particular MT4 loaded up, but these are MT4 templates with this exact drawing on them. So if you loaded that template, that's what would have been on your charts. And last but not least, I post these H1 chart pictures, which is what we're looking at right now. Okay, so we're looking at an H1 chart picture from last night, posted right after our pre-market session. Okay, with our level 1 AFP short and GJ. Okay, and then as well, we had these D1 traps, which I love. This up here. And this gray box obviously was covering the trap area that we just covered together. This top edge of this gray box was that single top edge of that D1 chart that we just looked at. Okay, so it was all set up for you if you wanted to dig into this thing last night. Okay, so now we're coming up to an H1 chart on the left, an M15 chart on the right. This is the WSM viewer I'm using. I'm using static shots of it because it's easier to deal with it in the flow of teaching at this point, for now, for this lesson at least. I definitely like to keep it up and around. I like to walk through things, and yeah, absolutely. I mean, this is basically one of our tools that we like to use. And let me see something here, see why we didn't get it there. So anyhow, again, you can walk through this yourself, okay, and do all this. But that was Monday. That was the peak, right? So there we go. I just want to show you one last thing here on the viewer because it actually helps. We'll go to the last candle of the day. Okay, so last candle of the day was right here. So that gives us the accurate pips to high of the day. 81.8 to the high of the day. Okay, so it was actually more than 75 to the close of the day, 80 pips. So we'll get that out of the way. We'll get back into this edge of 1 a.m. So we're now at the edge of the 1 a.m. box. Okay, so pop quiz time here. I'm actually glad there's a new person or two here because this is primary information for trading London patterns, which London patterns are extremely amazing. And it is the basis of what Steve's mentor taught him. And if you go back into Steve's past, obviously, he had a meeting one night at Arby's, of all places, with his potential market maker mentor. And his market, let me get the other one. His market maker guy drew that on a napkin for him. And then Steve was like, who is this guy? I don't understand. And he went back and looked at the charts. He was like, my God, this stuff is everywhere. I got to learn from this guy. And then Steve made it happen. All right, so anyway, that was the original London pattern. And so what we've done is we've built a series of London pattern cheat sheets, one of which I do want to show you here because I recently updated it, and I want you to grab it, and I'll post the link for it here. So any of the materials I bring to the teaching always end up daily market review, and they come, and it's in this AFP MT4 tools section, so that's spreadsheets, MT4 indicators, everything, all the tools we use, even sometimes markups. That's all the tools, but in this case, I put a markup here. It really should be in the benchmark section, but I goofed, whatever. Anyhow, it's the BTM and Essence cheat sheet updated. And what I did is I added the Type 2C London pattern. We don't need to get all into that right now, but I do want to drop this here for our humorous friend here. For you, Vlad. Okay, so load this thing up and put it on your wall, right? Print it out if you must. Whatever you have to do to make this thing live and breathe inside your own mind. So we're just I'm going to, whoopsie, I didn't mean to shut that, but I'll take one of the previous ones. I don't want to cover that Type 2 London pattern thing. We'll get all off track here. But generally, I wanted to show you the London pattern idea here. So this is the sheet. Want you to be very aware of this. So that GU looked exactly like this sheet. The only difference, of course, was instead of 2 spikes, it was 1 spike. And instead of a W down here, it was chop action to the left, right? It was choppy to the left for weeks. And then you had your 1 through 3 up across 3 days. And a single spike up here instead of the 2 hits to the high. So it was still the market maker cycle. It just looked a bit different. And now what we're going to do is we're going to talk about the waypoints in here. So we'll do a little pop quiz here. So please type in, I want you to answer this fully, if at all possible. Please type in, what are the waypoints of a Type 1 London pattern? Please take your time and type it in. Okay, now that would be just one of the waypoints there, Fernando. I'm looking for the whole set. There should be In this case, there are about 5 or 6. We'll just say 5 to make it an even 5. There are 5 things that really happen. This is actually, I want to clarify this. What are the waypoints of a type 1 London pattern up to the entry? We're not going to talk about after you're in, after the entry, and after it moves. We're not talking about that. We're talking about what are the things you need to see on this chart to have what we would consider as a technical confluence for our entry. Okay? All right? And I want you to be very specific in this because, again, I saw a chart last night in Steve's class. I couldn't believe it. I was like, oh my God, that dude doesn't have the catch-up in his chart. I pecked away at Steve only once. I didn't want to annoy him because everybody's there typing into him. But I was like, my God, get that guy to put the catch-up on his chart. So basically, I just gave away one of them. So, yeah, let's walk through it together then. You should all know. These need to be just almost ridiculously like off the top of your head. Bing, 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 bing. And if they're not, that's why we're here tonight, right? Break of Asia range. Absolutely number one. You do, and again, we're using as our benchmark. Let me grab the photograph again. I guess I can use Steve's napkin. Let's do that. It's kind of cool. I usually use the BTMM cheat sheet, but let's just go back to basics. Okay? So let's just go here. All right, so again, in order to have an M or W outside of the Asia range, you have to have a break of the Asia range, right? That sounds awfully silly. Okay? All right, threading the EMA. That's a nice answer there, Johnny. I think you're getting it. Okay, so break of the Asia range. So we're going to watch this play out together, right? But at this point, we're just, let's just get them up there. Okay, so the next thing you want to see is a close back below the catch-up. Do you all understand what that means? And if that's new to you, boy, I'm glad I'm doing this lesson because this has to happen before you do any of your algo looping. Before you go back and validate this stuff, right? Before you go into this world, you need to know some rules so you can see if a trade's actually confirmed, if it's technically setting up. And these are early trade confirmation rules. These are the original ones that were generated at the beginning. I guess beginning would be 2011 and 12, right? So these are rules that we talk about. So close above the catch-up. So it's a break of the Asia range. You're obviously above the catch-up right now, so you can't close above it. It's a close back down below that catch-up, right? Below the catch-up, you want to have a close back below, okay? Then you want to have a close back above the catch-up. So break of Asia range, come back, close down below the catch-up. Close meaning a 15-minute candle has closed. The candle is in a position that it is closed and it is above the catch-up. You need another one that comes down. However high it goes on this first move outside of the Asia range, you need another one that comes down and closes below this catch-up. A close of the 15-minute candle. Then another one that's creating your second leg that runs up to do what? Close above the catch-up. You need to have it close above the catch-up, right? And I know, Johnny, that's what you mean about the threading the catch-up. That's actually correct. TDI shark fin is not a requirement for this, in my personal opinion. Okay, is this a shark fin? I guess you could say it is, but shark fins are normally way up here. I'm gonna just personally, the way that I operate more like this napkin. So you can bring an RSI, which is what this is. It's a multi-time frame RSI. It has excellent uses if you spend the time and study it. I'm just not an RSI person. Some people are, and that's great, and it works very well for them. But I want to show you this without that. You can, by all means, in your algorithmic historical work, go back and run that into your calculus for a signature trade, put that in there, no doubt. But I'm not going to say here for any bit of time that it's a requirement. It often happens, but I'm trying to keep it price action at this point. Okay, and that's done me right so far. And back testing it's done me right as well. If I can hit 80% in back test, I'm all right. Okay, so close above the catch-up. So we've got those. And the next one, now you have your M or W that starts to form. Okay, so we have a very clear idea here that we're going to break that catch-up below. We're going to break out. We're going to break below. We're going to break out again, and it's going to be on the other side of the catch-up. Then we're going to see this thing start to roll over. That's the beginning of your M and W. Okay, so those are the things that you want to see forming in a type 1 London pattern, right? So it comes down here. Steve didn't have a red pen on him, but the 13 EMA would be just inside this pullback here. Okay? All right, and number 5 is the close back below the catch-up on the second leg. That gives you your technical entry. Okay. Trap to the left, you can add all that stuff in, absolutely. But what I was looking for essentially were the 5 basic rules of a type 1 London pattern as written. And basically in sync with our drawing here. And this is, I should have probably also prefaced this, a type 1A, which are these full 13 EMA rules, right? So full 13 EMA rules will show you it actually happened last night. But I'm giving this to you because these are the most powerful 15-minute London patterns that you have. When it taps the 13 EMA, it's just not quite as reliable. When the leg doesn't touch the 13 EMA, not quite as reliable. But if it actually goes on both sides of the 13 EMA, you have more market volume happening. You actually have more liquidity, which means, generally speaking, the imbalance that we talked about happening over here, the upside down nature of the market is even greater. Okay? So it's very important that we get this part through. Waypoints threw me. Sorry about that. But I meant waypoints pre-entry. Yeah, usually I talk about waypoints after the entry, right? We've done that a lot. We've talked about, okay, now you're in a type 1 London pattern. What are the waypoints as you go? But a waypoint is just the name of a division of time where an event happens. So in this case, we were looking at pre-trade waypoints. I could have probably said it far better. Okay. So here we go. We're busting up. Let's see what we have. Break of Asia. Check. Okay. See how it breaks Asia? You obviously can see that. Okay, we come back down and see the close below the catch-up. May have seen that as a close below the catch-up, but this was definitely a close below the catch-up. You can see how the next candle has opened. Okay, so check off the list. In this case, we have a nice fast move back up. All right, so let's just go back here. So what just happened here technically for type 1 London pattern traders? What is the event that just happened at this moment? And I'm super glad we're doing this based on the answers that I'm seeing. I want everybody to really have this, because if you don't have this, it's silly to go back in our algorithmic sheet and do that. Okay? We'll show a bit more of that as we go here. Right? First leg is correct. Your leg 1 is completed. So this is essentially a leg 1 of a potential type 2 London pattern, right? Let's just park the drawing right next to it. All right, so we had this leg 1 form. It came back down. So now you could put some type of alert on for price if it gets up in this area. Remember, these are each 15 minutes long. So when it achieved the high of the day, an hour and 15 minutes later, it came down to actually confirm the first leg. These are slow markets on the 15-minute, right? So you could put an alert up here. I wouldn't put it at the very high. I'd put it just inside, just so you're not watching too many pairs at the same time if you're one that likes to watch several pairs, like myself and Carr. But anyway, an alert up there for the second leg. So yeah, your first leg is confirmed. Okay, now we're breaking back above. And I guess in some cases you could say this is the confirmation of the first leg, because it could have just kept going down. But you get the idea. Now we're, for sure, dealing with a first leg that is confirmed, closed below the catch-up. We're now in a possible second leg condition here because it closed back above the catch-up. Right? Closes above the catch-up. So now the next thing we want to see is we want to see the beginning of this M. M, right? We want to see that thing form. So we get this. We get a single pin. And this is where a lot of our new traders get a little bit ahead of themselves. They're like, oh my God, it's a type 1 London pattern. I'm getting in. But really what I want to do is I want to send you back into an algorithmic historical back test, or backfest. That's what I call it, backfesting, with these rules before you put on a single trade. That's the idea. Okay, so you've got a second leg there, right? Check. Our M and W starting to form. We got the pin. That's the beginning of the M rolling over, right? Okay, note the time, 3:45 a.m. It's basically a Brinks candle. 3:45 a.m. is the Brinks candle. But what do? They rise up. They jump up. Okay, now, from a technical standpoint, you have not had a confirmed entry on this yet. Let me repeat that. From a technical standpoint, you have not had a confirmed entry. Our confirmed entry is what? It's this number 5 over here, the close back below the catch-up, right? Okay, they hang up there for a little longer. Anybody see anything interesting on that chart? So again, we're walking through this thing, and let's just get the time in there. So 4:15, so a half hour later, this is what the chart looks like. They've basically spent 45 minutes working this high, loitering at the high. And I started this lesson last night in the pre-market, probably not the best venue to do it in, but I'll ask you here, why do they loiter at high of the day? Why does a dealer do this? Why does he sit there at the high of the day, even if he's fully intent on running this thing short? What is his reasoning for sitting here? Why would he do that? because he's greedy. Funny, Fernando, but not correct. I guess it is correct. Well, I don't know if they're greedy. They're just so systematically good at what they do. It's almost beyond greedy. I don't know. I think it's something else. Greedy brilliance, maybe? I don't know. It's not greedy if we're here teaching it to you and, we haven't had red dots on our head or anything. So, I don't know. I wonder on the big scale. Makes people want to go long. Monkey mindset. Vinesh, correct. Why? Okay. EMA is turning up. Yep. That's the idea. Michael, you're cheating. You were with us in the pre-market last night. Anyway, you see how these EMAs are spreading out? See this kind of spread that's going on here? See the ketchup, the mustard, the water. See how they're all spreading out right there? Okay. Nobody typed it in yet. Inducing buyers. Yeah, that's correct. Robert, absolutely. Morris as well. Collecting contracts. Yes, that's correct, Vladimir. But it's more so allowing time at a high is a confirmation for a lot of the traders that we would consider to be not really well trained. I've used enough monkey illusions tonight already. I don't need to go show the same pictures again, but you get what I mean. So when you see price sitting at the high of the day and it sits there for 15, 20, 30, 40, an hour, that has a tendency to psychologically push you into it going long. The other thing that it's doing, which is the actual correct answer, I was hoping people, there you go. Vladimir typed it in, first day student, pretty good answer. Technical confirmation. Now, what this is this is an opportunity to allow trading systems that have been designed to take breakout setups like this. Right? Look at how this candle is just a little bit above this previous candle. There are certain trading systems that use EMAs. They use think of all the fancy gadgets that sit down here. TDI, all of that stuff, right? Name it. There's a ton of it. CCI, all that garbage, right? All that stuff is starting to now churn higher. And there's a point at which trading systems actually start to kick in. And those trading systems kick in, and the dealer sees this stuff on his terminal. He's watching build up of orders, more stops hitting the low, more stops being placed. Just imagine the advantage if you had that. Imagine if you could see the majority of green up here of the buy orders and all their stops being put into the screen. And then you can see the sell orders up here, just very few of them, very few sell orders, and just a few of their sell stops sitting above. Just imagine that advantage you'd have. Well, I'd be kind of cool with helping a small group, get out of what's called disintermediation, where central banks produce cash and it only goes to the banks and it never makes its way into the economy. Cough, cough, right? Cash disintermediation. I'd want to probably level that out. Why not? With that type of advantage, it's not as if a bunch of retail traders are really going to put a dent in it. You know what I mean? Anyhow, so that will leave that to speculation. But we know that certain trading systems actually trigger right here. Basically, as each candle stacks up and time moves, these EMAs all flip up. All of these technicals flip up. That's where you have all the technical validations of all these trading systems. Okay? All right? Very important stuff here. You want to have this knowledge in the back of your head, especially if you're a high-day trader and you're on the top edge of this candle. It's actually a confirmation that they're going sideways like that, and they haven't taken out the high. In this case, they barely just nicked it. But I want you to be thinking of where your stop loss would be in this particular scenario. Again, this is from GJ from last night. I want you to think about where your ideal stop loss is in this scenario. And of course, we don't have to go too deep into here, but we did have the inverted hammer on the 15-minute chart, right? So I'm hoping some of you saw that as well. An inverted hammer is a little tiny M on the lower time frame. Anyway, just thought I'd mention that. Thank you, Gary. Again. All right. So we have the pull away. So again, you're noticing this type of stuff. That dialogue in your brain is going to help you as a trader in such a great way. Okay. Now something happened which is actually very meaningful for us. You should all be able to know exactly what this is. All right? Makes some sense. Very nice, Michael. Very nice, Brad. So I was asking you where you're thinking about putting your stop if in fact he did what he just did here. And Brad's actually technically correct. Michael, you said part of the answer, but in what relationship to that answer? Right? Below it, at it, above it? Which one? Yeah, correct, Michael. Okay, good. Yeah. All right, so we've closed below the catch-up. Now, do you see this? Okay, see how clear that is. Break of Asia range. Close back below the catch-up. Close back above the catch-up. Close back below the catch-up. Catch-up's the red EMA, right? All right, so super, super, super simple here. We're really talking about something that's a nearly effortless technical validation on a trade that is a very high probability trade in some pairs and in some circumstances, that if you are going to back test this thing, you will be confronted with the sheer beauty of these babies. Right? You will be confronted with this on a regular basis if you go back and back test it. But it's not just as easy as putting this on if I see a 15-minute chart do this. Right? It's got to have the H1 and the D1 and all the rest of the time frames, and you have to have your reward risk ratio worked out. You have to have where your stop goes worked out. That's the next item I wanted to query everybody on. Because if you're scratching your head and you don't know where the stop goes, you need to think that out. Okay? So I already asked you that. So do I put it just above the high of the day? Maybe add in a little bit for the spread. Do I put it at the 0-0, or do I put it just above the 0-0? What do you think? Anybody? Anybody? Okay. I see one above, but I'm hoping there are more people that know this. Okay, now why would I want to do that? Why would I want to put my stop loss above this 0-0 figure? Yeah, in hindsight, above the 0-0 figure, Fernando says. Volume, yeah. There's a big fat amount of volume that's sitting right here at the 0-0. Oftentimes, right, the dealer will come up, hit the 0-0 in reverse. So even though we have a confirmed type 1 London pattern, we're always ready for them to throw another leg, right? Always ready for them to throw a third leg. Just it's the nature of these things. Okay? Because remember, these guys are sitting back in whatever high-tech terminal that they have, watching how the orders are building up to the long side, right? As they loiter up here, and how many stops are available on the bottom edge of this. And so as they work this thing back down, they might figure, we want to get more people committed long. We don't see quite enough longs yet. Let's run it back up again. And in some cases, they come right to that 0-0 or just in front of it. They obviously can go through that 0-0 as well. It's not a statistical guarantee that they're going to bounce right off of the 0-0. Shady brokers will widen the spread if they get even close to that 0-0 to take you out, right? So shady broker taking you out, that's something you have to watch at high and low of the day. That's why they widen the spread at high and low of the day. Some of them do, not all of them. We've managed to, fortunately, see some students find some brokers that don't seem to do that yet, right? But that can always change. Remember, a good broker today can become a rascal tomorrow. It really depends on how well they're balancing their desk. Okay, so something interesting for you to think about. You don't ever want to say this broker is great, this broker is bad. It can flip around. Brokers that were crap 5 years ago that did every game in the book, with the exception of a few suspects, those guys can turn around if they get really, really big because there's a monopoly of U.S. traders being funneled into them, and there are only two big brokers. They're going to get so big they don't need to play that game anymore, right? So don't ever look at a broker as a static entity. They're changing over time. Just like any company, any corporation, they change in their business model over time. So you're assessing your broker on a real-time basis, hopefully. But anyway, you want to get your stop above there in order to weather the pullback that's just below the 0-0, the pullback that taps the 0-0 and drops, right? It's not going to be any good if you're going to get the pullback that breaks the 0-0. You're basically going to be out. You have to reassess the situation. Is it a board-clearing move, in which case they close back down again, and based on your historical chart work, you get back in again to ride it, right? That happens actually quite a lot. Okay, so we're going to just assess this market right here where we are. We're going to look at close back below the catch-up, a confirmed trade. Two ways we can enter. One is a market order. The second is wait for a third back. It's a very small candle. So maybe for the third pullback, I do the third pullback on both of these candles. Right? Carr's rules are a third back on the shift bar. It's really not a shift bar. It's more of a little stubby guy. And we're already basically a third back on that one. So maybe you can run a fib in here and get a third pullback. So either way, you want to enter either at market or on a third pullback, right? Run a fib in there, wait for the third hit, and it runs up and charges right through there, and then it runs up and hits high a day again. Now this is what a lot of people aren't ready for when they're trading London patterns, and this is when the chimp starts getting involved, and this is where I submit to you that you have to have a plan ready to execute. Or in your case, what I would consider in London patterns is having an ability to actually hang with this trade, right? Your stop is far enough out that it's not going to knock you out, okay? So now you're starting to see them fade off that high of the day. A lot more trading systems have just gone long here. So really what we had is we had a confirmation of this thing as well. Just looking at this chart and its current formation, I would include the H1 and the M15. Is there anything that reaches out to you that says it's probably a good short? And I've been talking about this for quite some time. What do I mean by 0, 0, the price figure? It's this dark line right here. That's a 0, 0 price figure, right? It would be 141.00, right? The suffix of this number is 0, 0. You still think it might hit the zero and hit the stops? Yeah, obviously it can, but they don't have to. It depends on how much money they have here. The one thing that's working against that is that they've accumulated so many orders long at this point. Look at this thing. It's a wedge. It's basically not a wedge. It's a channel going upward. I didn't draw the channel lines on this. I could have, but it's a channel headed longer. Okay. Anybody else see it? Anybody else see what's going on? Why else would you want to be short on this? Go ahead. Jim, in my case, I see day open price that close. I would wait to break it and retest it. Yeah, that's valid. I mean, if you wanted to wait for the pullback to day open price, that's basically another trade set that's basically an adaptation. So that you'd be considering entering down here, and that's valid. But in order to enter down here on solid setups, you really want to learn these anchors, and you want to learn these very simple rules about the anchor to be able to get going on it. Okay. So I take you over here to this H1 chart, and I'll blow it up. And I'll ask you if you see something else that might be interesting for a possible short. And I think you see it. Okay? Yeah, inverted hammer. Hanging man is the other name for it. Right? Inverted hammer. They're oftentimes the top edge and bottom edge of moves. Right? You can see them sometimes all over the place. But in this case, it painted on the H1 chart. It was just part of another signal that it was going to go short. Okay, so now we have the third leg that's formed. So now we've closed back below the catch-up. So in a sense, we have leg 1, close below, close above, close below, leg 2, and then close above, close below, leg 3. So we have 3 legs. So that's a 3-legged type 1 London pattern, type 1A London pattern. Last night in GJ, away from peak. Unidirectional as far as our market, pre-market was concerned. You were not going any other direction with this setup by any stretch. Okay? Confirms again below the catch-up, right? And someone's typing in 2 inverted hammers. Yeah, it looks like 2 inverted hammers, but it's really not because this one hadn't closed yet. This one was still in process. This one closed. You need to have an inverted hammer or hanging man. It's got to be a closed candle. This one looked like it, but it hadn't closed yet. But that was astute pointing that out. Okay, confirms again below, and now presumably we're in this, right? Presumably we got in back here. So in your back testing of London patterns, you have to make a determination. Are you going to scratch out when it comes up to the high of the day and then get back in again? And if you're entering down here on a 15-minute chart, I submit to you that if you scratch out, your scratches are always going to be negative. So you could put your stop far enough outside of the vulnerability zone and just weather these pullbacks. That's another statistically viable way, or we could say it's another strategy that can be viable for you if you have the patience and you do have the ability to have continuity in front of the charts. Which, again, I'm basing this lesson on a pure type 1 London pattern, right? There's all sorts of ways we can get in here on the M1 and take these short. I'd prefer for them to break that 0-0 before I got in on the M1, but that's another story for everybody. I just wanted to show you that this was a 3-legged safety trade, for lack of a better word. It's a non-cross safety, meaning the 50-200 did not cross. But it's still a safety trade. It's still a M formation away from peak, right? Okay, so we're gradually getting lower. There's your break below the day open price, and this white line is day open price. Okay, it's running down. So now you're at this point, this juncture, this very important juncture, right? So you can see the swing this entire day is 52 pips. I didn't get the candle distance exactly from the low, but we could eyeball it here. We're 24 pips to high of the day, so we're going to say the bottom edge here is 30-something, 32 or 33 to the low of the day. Okay, so on a 5-minute chart, perhaps, let's go see what a 5-minute had on this. Let's just go have a look here, and then we'll be able to ascertain the actual bottom edge there. So let's throw up a 5-minute on the second leg, right? So here's our first leg, here's our second leg, this is a 5-minute. So you're 8 pips from the high of the day, right? So maybe your system is to not have safe stops on a 5-minute since you want to retain a high reward risk. Okay, so let's just run it down. There's your third leg. Okay, so notice the fast move above and then below on the third leg. Now again, this is the catch up from the 15-minute, and then this is the 9 and the 18 that I bring into this trader floor version of the 5-minute that some of you are digging. Okay, so now we're going to run it down. I want to basically see what the bottom edge of this move is from a a pip distance. So there we go. So high of the day, I was a little short. 36 plus whatever the tail is on this. So we're just going to call it about 36 pips from the top edge to the bottom edge. Remember that number. As you're back testing, that's going to be a constant. You're in various pairs. You're going to see certain pairs. They always go about 30 pips and then they run it back for the second push lower, right? So what we're expecting in this is, obviously we've had our 1, 2, 3 legs, which is really nice. We've got the shift phase. Now, oftentimes they give us one of these pullbacks before they dump it into push 2, right? And push 2 can just continue trucking down. It is GJ after all. Okay, so that's a nice, neat way, again, in hindsight, for you to go back, use a couple versions of the viewer, and pick out exactly how many pips to the high of the day. That will help you in your back testing bigly. Okay, so the bottom edge of that candle is probably about 37 pips. Okay, so again, we're following through on a 15-minute chart. Okay, so our entry and stop loss was about so. So if you're on an M15 chart waiting for M15 entries at confirmation, which the more you get into this, the more you feel like you're a little late when you're entering. Okay, so what we want to do is we want to get you poised so that you can watch that 15-minute, but then enter on the 5 when you're only 8.6 pips from high of the day, right? And then get your stop on the other side. If you want to get a safer stop, you can, but this is definitely higher than where this thing is going to confirm. It's going to confirm down here, right? So you can translate into the lower time frames if you want to get a little better of an entry on that, right? Then instead of this 1-to-1, you might have a 2-to-1. Okay. So what I want to illustrate here is the science behind this idea of back testing, because it's very important. So we're gonna take a little left turn here as we go, and just for those people that need to go to sleep, obviously peel off and go to sleep. It's been an hour I've been with you. I don't feel you're not doing me a disservice if you click off and watch the last half hour of this when you wake up, as the recording, it will be posted. But generally, I like to make this little shift an hour in to other content, which is most important for us to understand. Okay, so this is a 1-to-1 reward risk ratio. So you had 1 unit of entry stop loss. So your distance between your entry and your stop loss is basically the same if you took profit on this candle about this area, right? It's a 1-to-1 ratio. Maybe it's a little more. Maybe it's 1.12 or something like that. It gets a little deeper because we came down a little more. Notice that they bounced off weak open price. So that's open price for the week, right? That's this area over here. Okay, but either way, this is the first swing. So if you're going to enter confirmed on the 15, you're probably not going to get more than a 1-to-1, generally speaking, unless you wait for the pullback into the second push. Okay, so just think about that in terms of your calculation. If you only want to grab the first swing, you want to be on the lower time frames. So 5-minute or 1 minute. Okay, and again, alluding to Steve's lesson last night, look at the flat print going on up here. See that? Okay, so that video is posted, by the way. You can go in the forum and watch what Steve did last night. Okay, so 1-to-1 reward risk ratio on the bottom edge of this move. Okay, you got that? So now let's dig into this spreadsheet that we posted, last week, but it feels like months ago. It's crazy how time does not fly when you're busy. I don't know, it feels like so long ago. I don't know, I've been digging into this. Anyhow, so this is obviously some work that I did on a given pair, in a signature trade. I don't really need to deal with the signature trade, what it was and all that. But this is essentially how you're going to start to look at any signature trade, any trade that you execute. You want to know this information. This is your basic information about your trade. And you want to know how many wins, and you have a given period. Now, this is what hit me today, and I didn't have enough time to get this done in slide form, but Steve mentioned last night a 30 trade set of setups, right? That becomes your sample set, and it becomes your performance base, and you say, okay, I won so many, I lost so many in a row, right? You get a performance base out of the last 30 trades. You don't judge yourself on the last 2 or 3 trades, certainly not the last 1 trade. You judge yourself in the last 30 trades. Well, we can apply that same thing, and you can go back in time and just backtest 30 trades. Why not do that? If you have a signature trade that has solid rules, which basically we just gave you here. We gave you solid rules in terms of our threading of the 13 EMA. Not much of a shark fin, but a little bit of a shark fin for those that do look for TDI. I'm not interested in that for this particular trade. But you get what I mean. We had strong technical rules. So realistic expectations. You're probably not going to get a 2-to-1 on the first swing if you're entering with a safe stop outside the range like this, which for many of us, this is actually the place to put the stop and just weather the pullback. Just weather the pullback. With a lot of these, they do this a lot, and they never come back up and hit those areas. You're outside of the high of the day. It's probably likely that you're going to be okay if you have a really good reason on the H1 chart to be short. Anyway, so we released this Excel sheet last week, the excellent Excel sheet. And in this case, we got 48 wins and 19 losses with a 72% hit rate. Okay, that's a 1-to-1 ratio. This is simply going back and seeing, okay, it won here, it lost here, it won here, it lost here. Okay, now what I submit to you is that if you're looking at a 2-to-1, these numbers actually get a bit modified. Okay, so think about this when you're going back and you think 72% hit rate, oh, it's not 80, I want to get it up to 80. Well, if you're doing a 72% hit rate and your trade is at 2-to-1, that actually has a higher effective win rate than 72%. And let's just walk through the math for those so inclined, right? So if I have 48 wins and 19 stop outs, my stop outs are 1 unit and my wins are 2 units, a 2-to-1, right? If I'm looking at a 2-to-1 and I'm loading up this Excel sheet, this isn't really your true win rate, okay? Your win rate would actually be a function of the math we're going to go over here. So it's times 2, so 2 times 48, right? That's 96. Okay, if your win-loss ratio is 2-to-1, okay, over here you maintain the 1, so the 1 doesn't change. This is the 2-to-1, right? 1 is 1, so you have 19 stop-outs, period. They're all 1 unit. Okay, then you do a little math here, find x, just like in math class that you had when you were, cross multiplication, all that, very easy. 19 times 100 divided by 96, that's going to give you obviously the 1979, which we subtract from 100, which actually gives us our effective rate, or win rate. So our effective win rate on this, if this trade is a 2-to-1, that was actually what I was looking at. I was looking at a 2-to-1. I could possibly stretch this into 2.5, but I was looking at a 2-to-1. I realized that my win rate effectively is larger, right? So it's an 80%, 0.2, just generally speaking. Okay, from a sheer expectation standpoint, it's a 772. But if you really want to get into the fundamental math of it, it jumps up. Okay, so just wanted to make sure you're all aware of that. Okay, so this again was another bit of information. It was much less information. Okay, let's go back to this data sheet. What's great about these data sheets, the way I designed it, and it's we want to see an entire year, but you only see action on the populated part of your data. So our 5-minute, this was a 5-minute London pattern entry. And on this data, our 5-minute WSM chart data only goes back to April of last year. So this is actually not quite 3/4. It's almost 3/4. And it shows it eloquently, right? You can see how January, February, March, a little piece of April is missing. We only have 5-minute charts in the WSM viewer that started up in April of 2018. So this is a data set that you can easily see through the year. So see how it's fixed through the year? So again, just getting you guys more into this excellent Excel sheet so you can go back and do the algorithmic historical work, because when you do this, you have a confidence level that is incomparable to the one that you're operating on for most of the time you've been trading, okay? So anyway, I wanted to talk about this effective win-loss ratio thing because it's going to be important for you to dial up. So then I get the same pair, same entries, same rules, same identical thing, but now this is the beginning of 2019. I've got some hiccups here at the beginning of January. In fact, I had 3 losses in a row that pulled this number all the way back. So again, you can see the data is only from it's basically 2 months of data, January and February. Maybe just not even a big piece of March. Maybe, yeah, I think I stopped right at March. So this is only January and February. We've got a 19 and 11, so 19 wins, 11 stop outs. But notice the hit rate is much less than 72. But again, if I'm dealing with a 2-to-1, okay, my hit rate's 2 times that size, and I have an effective hit rate of 71%. If I were to somehow go back and tweak these entry rules, right, I could get it up to 2.5-to-1, in which case my effective win rate would be 76.8. Okay? So this becomes extremely tiring if you're sleepy. By all means, go to sleep. Be awake for the markets. This will be recorded. Anyhow, sorry. But math often makes you really tired after an hour of listening to me, I'm sure. But anyhow, so 2.5-to-1, you'll have a 63% underlying win rate, but if your win-loss ratio is 2.5-to-1, that jumps up to 76.8. And you could imagine what 3-to-1 is like. Okay, so that's times 3, again, leaving this one 0, right, or effectively equal. It's 1. Leave that at 9. It's the same as having an 80.7% hit rate. So if you can devise a strategy that has a 3-to-1 reward-risk ratio on a regular basis, you can get an 80% hit rate even though your underlying hit rate is 63. I want you to just think about that, because this is something that I obviously was tweaked by it when I saw a nice 72% on the first round. Then all of a sudden it down to 63. You go to bed, you're kind of like, oh, what's wrong? Then your brain does backflips and stuff. It's better to do it in back testing than it is to do it live in the market, folks. So this is real trading right here, okay? So this is the type of stuff you do to prepare. So these are effective hit rates, right? Okay, so very important. So looking to take profit on just one swing or two or more swings must be a function of one's duly developed signature trade algorithm. You have to have this worked out way before. It's not about, oh, it looks pretty good, it's going to give me one swing, I feel like taking profit here, let me just take profit here, why not? Or, yeah, I really want to have a nice 75 pip take profit at the end of the day so I can post it in the Skype chat so everybody, gives me that aha, that attaboy. These types of stuff. You want to get those completely out of your brain. You want to be totally algorithmic by the time you trade something like this. So you need to have this worked out ahead of time. Again, you're going to pay a price by holding this, right? You're going to have a pullback, for instance. You're going to have this pullback. It's going to be possibly painful if you haven't had this stuff worked out. And if you, trust me, if you can work out something like this, well, let's just go to this 2-to-1 here. Okay, let's say you have a 2-to-1 that's 71% hit rate. And you have a year and a half of data that's so clear. It's just absolutely exactly these rules. You've done these exact rules. Okay, so I do submit to you that there are a certain amount of traders that are going to be far better off doing this because the market goes nice and slow. But your entry might be, 6 hours away from your take profit. You have to be able to understand that. But you'll have the nice, the buoyancy of spirit that you won't have to be fighting this thing if your stop loss is high enough out of the way, right? Those types of things. So some people, their personality is designed for this type of set. There are so many trade setups available to you all. I'm just giving you a slice of one of them here. And I'm kind of looping in the 5-minute just to show you possibly a 2-to-1. Possibly a 2-to-1. Let's go look at it. Let's just have a look on this. I think you did get a 2-to-1. So if we entered here, and our stop was above. And again, with the 5-minute, I might not want to put my stop above that 0-0. I might want to maintain my tight ratio. It really depends on how much homework I've done. Okay, come back and hit it again. Hope the dealer doesn't widen the stop there. Okay, come back down, come back down, come back down. Then this is the bottom edge of the move. So let's just calculate this out. So if my entry was on this candle and my TP was up here, I can draw about a 2-to-1 inside here. Okay, so I've got my 2-to-1 on the first swing. Right, so a 5-minute chart gives us a possible 2-to-1 on the first swing. These are all things you need to think about. If you're waking up in the middle of the night and you're going to go back to sleep, I don't want you staying up for the second swing. So you need to work that out. On a 5-minute chart, you probably got a 2-to-1 on this. And you could have been done, and you could have been in your 71% with an effective rate of 63, which I actually believe is higher for GJ, for type 1 London patterns, especially away from peak. Anyhow, this is like walking into one of those. If I were to grab a screenshot of what this represents, it's like a massive library with like thousands of books and 15 levels and gigantic ladders that are like 5 stories high. Because once you enter this world, you're in this just, the combinations are endless. But you need to wrap this around your timing. Am I cool sitting in front of a screen? Maybe maybe I want to multitask. Maybe I want to trade and do something else because I find trading to be so damn boring. It's just insane. Right? That might be some of you like that, in which case this trade is actually perfect for you because every 15 minutes you come back and monitor the candle. And you do what else you have to do, but you keep your charts close by and then you watch it play out over the days. Right? Or in this case, over the day, hours. Some people it's good. Some people that's going to work out. Right? And again, you've had the history so you know that it's valuable to do that. Okay? So let's go into some of this exciting stuff here. This is Nikita. And I'm not sure if I probably should have asked him if I should post this, but it was just so awesome that I had to say this. I had to share it with everybody. He's here tonight, so that's all good. I hope you're he, maybe you're she, and I got it wrong. I'm not sure if not, I'm apologizing. Please tell me if you're a girl, if you're a guy. I think you're a guy, but I could be wrong. I knew a Nico who sounds like the same name anyhow. Don't want to, no disrespect if you're a girl, but anyhow. Hey Jim, just wanted to say this win-loss matrix spreadsheet is amazing. I just finished doing type 1 London patterns on EU from January 2019 to present. First time around, I recorded just the pattern, no filters, going 3-to-1. Second time around, I added a higher time frame. Filters only taking AFP trade conditions or in line with D1 trend, also going 3-to-1. Third time, and when he's talking about third time, I want to just try to make that super clear for everybody. What is he talking about, this third time and the first time and all that? Let me load a blank one up for us here. Let's load one over here. Let me see here. I hope I have the latest one. No, that's research stuff, scaled above the waterline. DMR explanation example. Let's take this one that we worked on last week together. So I'm going to take this spreadsheet here and bring it across. So you actually have room for 6 separate executions of your signature trade with different rule sets. Okay, so that's what he's talking about. He filled this one out, he filled this one out, he filled this one out. And then so you can compare them at the end of the day, right? You can compare them so you have different. So in this case, I only populated 3 and I did it randomly. I didn't really take any time. I just wanted to show this. But this gives you a sense to do the 15-minute only. Maybe add some H1 confluences, some D1 confluences. Tighten it down a little more, maybe some trap areas, some zeros, some 50s, right? And then final tweaks with your stop loss to break even, that type of thing. And then you'll be able to see how you have developed your signature trade. It's kind of a top-down approach. It's very, very effective, and I'm happy that someone actually jumped on it like Nikita did. Okay, so we stopped here the 3rd time around. So that was his 3rd time around. I just wanted to make sure. 4th time around, I added the filter of only taking setups that trap through either the M15 Mayo or Blueberry or a Blue Tracer, also for 3 to 1. I got to say, this process completely blew my mind as I saw the setup go from 38 accuracy up to 85% accuracy. It just felt like I had to share with someone. And I feel the same way, Nikita. I just had to share with someone. We're more than someone. Someones. Lots of someones. Okay? So anyway, and I asked him about what setup he was doing, and you can see it down here. I forgot to mention. He also used a 00 and 50 figure to anchor his 4th run through. So his 4th tweak of his London patterns that he was taking on the M5, right, was with zeros and 50s. So he's used this thing exactly as it's designed. I mean, it's like, wow. I didn't think someone would actually do it that quick. And here are his drawings. So he did just the pattern, right? This is from 1/7/2019, which is accurate. That's the first Monday of the year. You have to make sure to put that in, right? And we have here, this is actually wrong. It should be 1/7 here. Okay, you would want to put that in. The first Monday of the year, you put that in. So if it's 2018, the first Monday was actually on the 1st. So this actually works out for this spreadsheet to be accurate. Then when you enter your trades, it all is accurate in here, right? So you have 3 trades a day. This conforms to our scaled risk above the waterline matrix, which is such an important spreadsheet on its own, right? This is the big kahuna right here. If you ever wanted to really figure out why most people blow their accounts, obviously they've got a little malfunction going on, but you get the idea. We talked about this a few DMRs ago, right? This is a completely whacked out figure. I probably did something wrong in here. So starting account balance. Anyhow, let's just reset this thing and see if it cooperates. No, it doesn't. Anyhow, something broke. I broke the sheet. That happens. Anyway, that works in your sheets, the ones that are in the forum. But you have 3 opportunities a day, right? A pull down window. You've got take profit, break even, stop out, and then you want to clear the box, you clear the box. So if I wanted to come in here and get rid of a stop out, say I had a rule set that on a higher time frame, I could, not take that trade. I come down here and do the empty square, and that makes that 0, and then the calculation slightly changes. Okay, so this is how you use that spreadsheet. He used it exactly in line with how we talked about it. So his first modification to his entry was D1 trend with AFP conditions, right? New scratch rules only take trades trapped through the Mayo 00 figure and Blue Tracer, right? So we got through all of 4 of these, which is fantastic, and his numbers went up. And this is what he would look at when you get to the comparison page, right? So this is why I wanted to make sure that it had this in it, right? This is our comparison page on the previous one, right? But you get the idea. Let me save this one. I don't want to tweak it. But you're able to actually see the comparison of the separate systems. Each one of them is labeled. The names are dragged right through, right across. So a nice short name. So he did it exactly as we designed it, which is so perfect. I'm so happy this happened. So this is what his 4th one was, right? Individual chart for trap throughs. So he's able to tweak his numbers out to get an effective 85% hit rate. Okay, so now he's got to add his 3 to 1 to that, so it's actually effectively much higher than 85%. Okay, what is your win-loss ratio on that? He said, was it stop loss? I guess I didn't read through his explanation closely enough because he actually said 3 to 1. And then he came down here and mentioned this, and this is where it gets variable. This is why I went, in this instance of this spreadsheet, instead of going for a variable spreadsheet, I wanted the very basics of it to be wins and losses, period. Because some trading systems will actually deviate. You'll do 1 as a 2 to 1. Another trade will be 2.5 to 1. Another trade will be 1 to 1. Another trade will be 3 to 1. Another trade will be 10 to 1. I wanted to leave that out of it for the basis of this sheet. If your trading system is on a fixed reward risk ratio, then by all means, add that in. But a lot of people use a floating reward risk ratio, which is fine as long as your hit rate is high. Okay, so he says 3 to 1, sometimes a little bit less. If there's a high volume area around 3 to 1, I'll target instead. right? So a little under 3-1 sometimes. Also close my positions before red news, right? That's another viable one. It might be a 1-1 or a 2-1, but most of them are 3-1. That's what he aims for. So he aims for 3-1, and then at some point in time, you may want to fold this back into like a fixed 2.5-1 or a 2-1 even, and then just up your lot size, up your risk, and make a heavier entry lot size. So that's a way to tighten it down. That would be number 5. You might want to look at just go for 2.5-1 and then try 2-1. You might find your win rate actually gets even higher. So anyhow, didn't want to dive too deeply into this stuff. It's definitely important though, and this is the library with the 5,000 shelves of books and the 11-story ladders. So anyway, this is just one of the things you'll have to think about. And then as we talked, he realized that he was using the 5-minute chart with the non-adjusted EMAs for the 15-minute chart. And that's not how he wants to trade. He wants to trade with the adjusted EMAs for the 15-minute chart. So he went back and redid it again. So he's obviously real quick at doing this with the viewer, right? So you have the viewer on one side. So basically this is how you're doing it. You're parking the sheet right next to you with the weeks and stuff, and the WSM viewer is just as easy. You can see which week it is. Normally you can use this guy and populate the week, right? So anyhow, you're side by side with these things, and you can quickly pop through it. And you pop through, and he even got a 78%. If he changed his rules to adhere to the 5-minute standard EMAs, which are not adjusted to be like the 15-minute. And he still got a very nice result. 78% with a average. Now you have to think about this, and I do want to compel you to nail this down at some point there, Nikita. So at the end of the day, I do not want you using a floating reward risk ratio. Okay. Now, when I say that, what I mean is for this particular process, at some point in time, I do want you to close the loop on that. That doesn't mean you can't trade it, right? So there are times where you see a 2-1 is absolutely going to hit. Maybe I can stretch it to a 2.5. You can add elective rules in your trading if you're really solid with something workable, that you've done this evolution of the trading rule, so you see the performance over time. So I don't say never do it, but for this particular suggestion, I would go into it. Just make everything 2.5-1 and just call it a day, right? And then run your numbers one more time, and you might see this thing jump up a little more. Just I want you to think about that. Even if your intention is to take elective exits in some cases, meaning a bit deeper than 2.5-1 or a little under 2.5-1, I want you to work out as your final trading algorithm. I want you to have a fixed RR. And that just helps you, because once you actually get into executing it, then you can make your adjustments. But at least you know the exact hit rate. Okay, you have what is it? It's a mean. You have an average mean that you're working from. So statistically, you're sound. Okay, so innovate after you get the absolute solid math of it. All right, and some people would say don't deviate at all. And my boy Jake, he's not deviating at all. He'd go for 2-1, and that's that. Wham bam, thank you, man. Back to bed. And he lives on the West Coast, so he can start trading London around midnight, maybe take a set or two and be done by 3 a.m. and just basically have a realistic life with his lovely wife. And all things are nice in the West Coast for him. So anyway, this is just over and over again, basically laying brick, like the old bricklayer, right? Trying to get, I think that they unfortunately took that one down. I used to have the bricklayer gift, but that's long gone. Anyhow, so you get the idea. So he's looking for 2-1. We started. We kind of traded a lot together, and we worked on the M1 stuff together pretty heavily. It's a good trade, buddy. So after you get through wanting that 3-1 so badly, it's like, oh my God, I want that 3-1. You start to see these occasions where it goes to 2.2-1, 2.3-1, and then it goes all the way back up, and you get out at break even. You're like, I could have nailed that if I just did 2-1. You do a little math here. You go back into this process. You're like, 2-1 is fine, man. With a high hit rate, anything above 60%. A 2-1 is golden. So you start to get a little less greedy and a little more systematic is what I'm saying here. Now, Vahur, I got to go through this one because this was equally as enlightening. I got another one after this, so bear with me here. He got an aha moment while making flashcards about projecting entries and targets at zone flips and trap areas. I decided to go over all my 301 EU London type trades again, and I'm filtering out my scratches and the couple stop outs that happened at the moment working through type 1 trades. My focus now is only to take London patterns that are safely at higher time frame D1, H1, H4 zone flips, right? So he's got some filters, trap areas, especially trades that are against the trend. I don't want to do too many of those unless I have a really good reason, right? And oh boy, how this is making a difference with the statistics. So I pretty much sent you initially to just do every M15 setup that you see and then start to apply these higher time frame filters, and then all of a sudden these lines go up like that, and you see the progress of your algorithm tightening up as you're doing it, right? It's a joy to behold. Okay? And so anyhow, continuing on here, makes a difference with statistics. Yeah, I'm getting 90% now, and the stop outs have disappeared. So he's taking scratches instead of stop outs. Brilliant. Interestingly, most of my scratches and stop outs were either taken too early, not at the 0050 figure, or in the middle of the higher time frame range. Yeah, all this stuff we've been teaching down here for a while. I do have one concern, however, and this is the one I wanted to get to. I'm afraid of the monkey now. What if my monkey is doing the algo work? You have to be ready for it. You have to be. It might be. He might be wishful thinking. He might not be looking at a stop loss. Might be making up rules as you go, right? I'm trying to be very objective. I also have filtered out even some wins that are not in line with the zone flips. Yep. You'll be losing wins and stop losses when you start to filter, right? But what is the subconscious? But what if the subconscious is also influencing this side in a bad way? Or maybe I just don't believe it. He's absolutely, completely on target there. I like your comment about the monkey during back testing too. And yes, he can show up at any time. Brutal honesty keeps him in the back seat. And that's a life lesson, folks. It's not only brutal honesty when you're sitting in front of the trading terminal back testing a pair. It's in your real life. You're bugged about something, tell someone. So, if they're bugged about something, you seem to be bugged about something, tell me about it. Spit it out, let it out. That'll keep the monkey honest. So it's basically 95% of the time of how you're dealing with life as a personality is going to determine that 5% that you're in the markets or that 5% that you're doing back testing. You have to be honest. You have to be brutally honest. But what I want to make sure you understand here is that without an honest accumulation of losses in back testing, there can be no optimizing of your trading strategy. It's not gonna happen. You need to stick with exact rules of entry, and every time that thing goes beyond your entry where your stop would have been, that's a stop loss. Make sure you write that out, right?